Live.
Hi, everyone. Welcome to the live stream with Jason Hartman. I am Ashley, your co host, back by unpopular demand. I've been very busy recently because I can't afford to put gas in my car. So I've had to walk everywhere, and it's just been taking up my time. And Jason's been busy getting his hair cut multiple times.
No, just once. Just
Once.
once.
All right. Well, it looks like you've been back there twice in 1 week.
Well, like I said on the podcast, I usually just go to Great Clips and I pay like $15 for a quick haircut. And it's easy because I can be in any city in the country and just they have an app. You can just go really quick. But this time I went and I paid $45 for a haircut. And because I paid triple the amount, they cut more hair.
Okay, I see. I see how it works. Yeah.
You see, you get more you really do get more for your money. They cut 3 times the amount of hair off, and that's why I paid 3 times the amount.
More bang for your buck, right?
Yeah,
That's
exactly.
the only thing you're getting more bang for your buck out of right now, actually.
Isn't that the truth? Tell you, wow, inflation is eating the world. There's an old saying, Ashley, a tech saying that's a really good saying, software is eating the world. And that is really true. But I think inflation is eating the world. Let's go, Brandon.
Inflation pandemic.
The inflation pandemic. Yes, that is definitely the case. But hey, it's good to be back here live. So I'm glad you came on and we're doing a live stream. We are actually live, not live and pre-recorded. And I've got something to show you, Ashley. I think you're going to like this. This is new stuff. Brand new. You want to see it?
Yes.
Okay, let me show you. Here you go. So take a look at this, everybody. This is a chart showing how households have this lightning debt load. Yes, I know it doesn't feel that way. I get it. But with these interest rates, I know they're higher than they were. They are still historically pretty darn reasonable. And also, in terms of other debt, a large percentage of the homes in the country are just free and clear. They're paid off. Most homeowners, I cited a stat the other day on the podcast that said that homeowners, the average homeowner was sitting on like $178,000 in home equity. But now there's actually a new stat that I just was reading about, and don't quote me on the number, but I believe it's $211,000 in equity. So, one of the things you need to have a real estate crash is you need a really financially stressed homeowner. And we just don't have that. There's just no evidence of that out there. The media reports things like, well, the foreclosure rate went up. But compared to what? There was almost no foreclosure activity at all. So it's, if it doubles and it goes from 100 people to 200 people, that's still a very small number of foreclosures. Now, look, I will be the first to tell everybody that there will be a correction in the market. We're just not there yet. We are really far away from it. But let me show you this. This is what's really going to blow your mind. It's not this chart. This is the new stuff. So this is from the St. Louis Federal Reserve website, and it shows mortgage debt service payments as a percent of disposable personal income. So what that's really telling us is, look, how expensive is it for homeowners to pay their mortgage? How expensive is that? How burdensome is that mortgage? Now, hang on here. Here we have the pandemic, okay? And we saw the mortgage rates go way, way down. And so that debt load was smaller. But then as the moratoriums and the lockdowns lifted, we saw the prices start to go up. We still had low mortgage rates, but then there was sort of this sweet spot here where this debt load was the lowest of all. And I think this is probably attributed to the fact that here a lot of people were going back to work. And
Mm.
I'm not really timing, and I haven't paid too terribly much attention to when the stimmy payments came out, or the, as your coworker said, my stimulation check. I haven't paid that close attention to the dates of those. So that may be it too, because that definitely has an impact. But here it is overall, right? So still, we see that this burden is relatively low. It's relatively low. But guess what? Guess what? Guess what? Guess what? What about when we look back to 2014 or so? Okay. Or, late, early
Mhm.
2015. We see
Mm.
that this debt burden was much higher 7 years ago ish, 7-ish
Mhm.
years ago, right? So it's only gone down overall. And then it went way down, and then it went way, way down, and now it's up a little bit. And
Mhm.
everybody's freaking out because they love to report on sensationalism, and they love to say, "Oh my gosh, the debt load is increasing." But compared to what? I mean,
Mhm.
compared to 2017, it's much lower than it was then. Compared to 2015, much, much lower. But wait, there's more. Let's go back even further and look at a larger span of history. Look at this. Does this amaze you or what? Now we can see everybody's worried that we are in for a repeat of the Great Recession. And this is how things looked as we were going into the Great Recession on the run up to that.
Mhm.
And then here was the worst part of all.
Mhm.
And this is where we are now. This, like, it is easy for people to make these mortgage payments.
Mhm.
It's just not a problem. Go way back to 1984.
Mhm.
I mean, George Orwell, okay, which sadly his predictions are coming true, as we know. And by the way, as I showed you yesterday morning, I picked up a newspaper. I actually bought a newspaper when I was walking the dog, and this, I'll put this on the big screen here. Um, this newspaper talks about how YouTube, can't say that, is doing this. Okay, they're the
Mhm.
C word. Yeah,
Yeah, of course.
and they took down some content from a Post reporter who interviewed a January 6th
Mm.
person. I don't even want to say the name, but
Mhm.
clearly the truth is being obscured, folks. It is
Really?
really Orwellian, pretty Orwellian scary. Anyway, back to the chart here. So this is just truly amazing. When you look at this, you just think, where is this overburdened homeowner? Where is this person that's going to go into foreclosure here? What is going to be the trigger for the supposed real estate crash that is coming? And yes, it will eventually come. But folks, there is no indication yet that we are very close to that.
Mhm.
Mortgage burden is very low. Housing inventory is severely low. It is so limited. It is, I mean, it's unconscionable, really. Now, it has been ticking up, no question. It has been going up since these interest rates went up, but it is still very, very low. So that's what I wanted to share with you. Any thoughts and any comments coming in on that too?
Yeah, we do. We've got some comments. RR says bribe inflation.
Yeah. Is that like, did you mean to say Biden inflation or bribe
No
inflation?
bribes, because we said inflation pandemic.
Yeah, right.
So RR, where are you from? What market are you in? And what is the median cost of a single family home? We just want to know. And what's the gas price?
We'd love to know. And by the
Yeah.
way, everybody watching and listening, please post a comment and tell us where you're located. Give us a sense of geography. We'd love to know where you
Mhm.
are, and chime in with any of your questions or thoughts.
And Matthew Heyman writes, I think most people bought their new homes first. Now people are selling their primaries first. we are going to see a lot more supply here soon. That would be
Yeah.
good.
Yeah. Well, let's see a lot more supply. I would love to see more supply, and
Mhm.
I've shared this before. It's nothing new, but people accuse me somewhat often of saying, "Oh, Jason, you're just a permabull. You're always promoting real estate." Listen, I want to make this very clear. I hate this market. This market is terrible for my business. Okay, I like a market where there's some inventory. Think about it, folks. You know, if it's like the supermarket that has shortages of supplies or the car dealer that has no cars to sell. We're in the business of helping investors buy properties. And if we
Mhm.
don't have properties, we don't have business. Okay? I don't like this market at all, but I'm just reporting on it and I'm telling you the way it is. There's a lot of reasons to be
Right.
bullish.
Sure, sure. And you're, one of your missions is to help middle-class people attain long-term wealth through real estate investments. They can't do that if there's, very little inventory.
Yeah,
And so the hollowing out of the middle class is just going to keep going
it
until
is.
there's nothing left.
Sadly, it is, and that's what we're trying to do here. We are on a mission
Mhm.
to save the middle class, and I think that's a really worthy goal. If you want
Mhm.
a
I do
stable
too.
country, you gotta have a big middle class.
Absolutely. Absolutely. Absolutely.
Yeah.
Great.
Okay.
Keto Man, South Texas, retired homeowner. Very nice to be retired.
Yeah.
Stay curious. Prices are starting to fall in Memphis and its suburbs. Okay.
That really surprises me. I mean, but they're falling from their insane heights, right? And,
Mm.
when you say prices are falling, I wonder if they are. And I'll just say, are they empirically falling, meaning are prices really down, or are you just seeing price reductions of overly optimistic sellers? There is a difference there.
Mm.
Okay.
Mm.
I don't think that's actually true that prices are declining. I think listing prices of sellers who overshot the market are having to face a little bit of reality. But overall, I really doubt you're seeing price declines yet. At some point we will get there, but inventory is
Mhm.
still way too low.
Mm.
Yeah.
People's Republic of Washington State, eastern part, 5.29 a gallon. Wow. Median
Yeah.
home price is $420,000.
These gasoline prices are insane. They
Mhm.
really are insane. And here from Lexington, we got another report from Eric.
Mhm.
Yeah.
478 a gallon.
Yeah. Wow.
100K.
It's ridiculous. But hey, just be glad you don't live in my hometown where I grew up, Los Angeles, where you'd be paying $7 or more per gallon. It's just crazy. But
Mhm.
Ashley, you brought a couple things for us to share with the audience. You want to go
I
to that?
did. Yeah, a couple of fun slides to look at this one because you're always talking about, you're always comparing different markets and what you could get in one market for the same price in another market. And so this is kind of fun. This is from Visual Capitalist, just came out. How much real estate could you buy for $1 million? And it
Yeah.
goes to show you by square foot what you're going to get in one city versus another. And these are, of course, these are all prime markets. These are big cities. These are what you would call cyclical markets.
Yep.
But if you go to the next slide,
But
um,
but but what this before I leave this slide though,
mhm,
what you see when you ask the compared to what question about US real estate,
mhm,
when you compare it to the rest of the world, real estate in the US is cheap. It
mhm,
is so cheap. I mean, look at these prices here, and these are all these prime cyclical markets that we would never recommend to invest in. There's one US market in here, of course, that's Miami, just south of me. And a super expensive market, but very cyclical. Miami goes way up, it comes way down during the recessions, and we'll see what happens. But overall, US real estate is just not that expensive, folks. It's just not very expensive.
mhm. Yeah, here we have a couple more U.S. cities on this list. We have New York in fourth place, fifth place
Yeah,
there, 358 square feet for $1 million.
yep, and Los Angeles. Yeah,
And the worst is Monaco, 157 square feet, but that's such a tiny country anyway.
Yeah. Yeah. So this is what you get for $1 million. You
How
get
many square feet
157 square feet in the little Principality of Monaco,
in Monte
and
Carlo?
Hong Kong 229. So in New York you get 358. Wow, that's just ridiculous, beyond comprehension. Los Angeles, you'll get a hotel room. You're still in hotel room category in any of these, and here you get to Sao Paulo, Brazil, and you get a house, and
You get a
South
house.
Africa, which
Mhm.
is now a crime-ridden shithole, sadly. But I've been to Cape Town; it's gorgeous. I'm sure you've been there too, Ashley.
Yes, it's lovely, yeah.
You know what's funny about you, Ashley? I don't even ask how many. I don't even talk to you about like places because we've both been so many places. But you're one of the few people that actually outnumbers me
Mhm.
on number of countries visited. I'm at 87. You're at 110.
Yeah,
And
111, so
yeah,
I've got a lot
111.
of
Oh,
catching up
that's
to do.
right. Yeah, good point. I didn't count that one. That was
Mhm.
when I first met you, was 110. All right, good. So next one, you want to talk about this?
Yeah, this is from our favorite reporter, Diana Olick,
Yeah,
over at CNBC. This came out yesterday. Mortgage demand falls to the lowest level in 22 years
yeah,
amid rising rates and slowing home sales. And then the third bullet point was what I wanted to talk about because I have a question from a YouTube viewer.
yeah,
Refinance demand dropped 6% for the week and was down 75% year over year.
yeah.
Okay, so my
Yeah. So,
question. Mhm,
well, yeah, before we get to that, one of the comments I want to make here is that, of course, the mortgage industry, the real estate industry as a whole,
mhm,
and when I say that, I'm not talking about the real estate market. I'm talking
mhm.
about the industry, the people
Sure.
that work in it, all the people that work at escrow companies, title companies, settlement attorneys, of course, mortgage lenders, and all those affiliated people, and all the home inspectors and the appraisers, and it's a giant industry. Okay, all the realtors, of course, don't forget them, huge numbers of
Mhm,
realtors.
mhm,
uh, you know this is another reason that they are not going to want to see trouble in the housing market. Is because it's such a huge industry that comprises about 17% of the entire country's gross domestic product, GDP. So
mhm,
it's just a really big industry. But when you see this type of stuff about refinance demand being down, mortgage demand being down, that means layoffs.
mhm,
Okay. Now, the
mhm,
mortgage industry in and of itself is, not huge, but when you put it all together, it is a big industry, right? And so refinances are very, very fickle and very cyclical because they work strictly on numbers, right? They don't
mhm,
work on anything else. It's either a good deal to refinance or it's not.
mhm.
And before Ashley gets to that question, please hit the like button for us. I always forget to ask you, so hit the like button. All right, Ashley, go.
Yes, go to the next slide. It's a question from Just a Fella, so from a young man. JH, at what interest rate would you use cash and abandon refi till you're a dead man? Or is it relative to inflation?
Yeah. So you're referring to refi till you die, which is
Right?
one of my trademark strategies, and refi till you're a
You're
dead
a
man.
dead man. That's kind of nice.
Yeah. That could be the name of a
Funny.
band, I think. Refi till you're a dead man. Interesting. Anyway, the answer to that question is probably summed up pretty easily in just asking yourself, compared to what?
Mhm,
And what I'd compare to is the rate of inflation,
mhm,
both official and real.
mhm,
So the official rate of inflation right now is about 8.5%. And the real rate of inflation, I say, is about 15%. So as long as you are borrowing below those numbers, below those rates,
mhm,
you're probably doing great.
mhm,
Now, if you add to that it's not a personal residence, but an income property, then you add all of the other areas by which you earn a return on investment, whether it be leverage, inflation induced debt destruction, tax benefits, cash flow, mortgage paydown, equity buildup, appreciation, etc. Right? When you put that all into the mix, then it gets even better, much, much better, right? But just very simply, just do it by the interest rate versus the inflation rate. And there are very few times in history, and I've shown charts before on the YouTube channel and talked about them on the Creating Wealth podcast, that show very few times in history. And when it has occurred, it's been for very short times, that the official rate of inflation is higher than a fixed rate mortgage. That is extremely rare. And we are still in that time right now, as everybody thinks interest rates are so high. And I know, because they're comparing it to several months ago, right? When, we had close to the lowest interest rates in 5,000 years. I kid you not, 5,000 years. But we're still well below the rate of an official inflation, and dramatically below the rate of real inflation. So you're getting paid to borrow money. So
Right.
just a fella, go borrow some money.
Right. All right. Let's take some comments and questions from
Or in the chat. Okay.
Yeah. So let's see. We've got Chris Six Strings.
And actually, you can call them out by number if you want. That's number 630, right?
30, yeah. U.S. is resembling Japan, where inventory is low and the population is declining under a growing wealth gap.
Oh, I don't agree with that one. Sorry, Chris Six Strings. I guess you're a guitar player, I'm guessing. That's good. Yeah, the U.S. population is not declining by very much yet. Overall, the world population is declining, and that will be an issue, but talk to me about it in about 25 to 30 years. Okay? Don't worry about it now, not in the U.S. We are far from that issue, and our situation is far different than Japan's lost decade that became the lost 2 decades that became almost the lost 3 decades. Japan is a very interesting problem, but you're very right to point to it as a demographic problem, because that's largely what it is. But there are, of course, many other factors. This stuff is really complicated, but Japan is a very interesting story for sure. And I'm glad you brought it up, because demographics are destiny, as they say.
Right. Right.
So should I say what I said the other day, Ashley? No, probably not. But
no, I know what you're going to say.
Go do what you need to do to have some children, people.
Yeah, I guess.
Yeah. We got a very strange YouTube comment on that one. Yeah.
Yes, but they were listening, so
yeah,
they got the message.
Glad we're listening. Yeah. Oh, and by the way, on the podcast next week, you got to remind me to talk about. One of my attorneys today sent me a link to a fascinating story about an insurance claim, an auto insurance claim that has to do with SEX. I couldn't believe it. Like, if this can happen, insurance companies are going to go out of business left and right. Our insurance rates are going to skyrocket. It's insane. Next week on the podcast, I got to tell that story. It's shocking.
I'll remind you. Okay, so 631, Matthew again. I think Jason has done an unbelievable job at kicking the 1031 ball up the hill.
What's that mean?
I love that.
I don't know what that means, really. I don't get it.
The 1031 exchange ball.
Right, but how am I kicking it up the hill, Matt? I don't know if I get it, Matthew.
I think
you get it, actually?
That you're doing a good job, that you've successfully rolled a lot of your properties over the years into 1031 exchange.
That's true, and I'm doing one more right now as we speak. But the 1030, that's one of the things I got to mention. When people calculate, income property is the most tax favored asset class in America, and taxes are the single largest expense in pretty much anybody's life, right? But and so that's great that you save on taxes with income property. It's awesome. It's a great deal. But no one can really calculate how much you save over the course of many years or a lifetime, because you can do a 1031 tax deferred exchange. And instead of selling your asset, paying tax, and then taking the money that's left over after the government takes its very generous cut and reinvesting that money. You get to sell the property, avoid the government, give them the finger, and say, I'm going to reinvest it all. Tough luck, Uncle
Mhm.
Sam. And, that cannot be underestimated because, you know, I don't know if I can say never, but certainly in probably 2 decades, I have not paid tax on a real estate deal. Yet I've made a ton of
Mhm.
money on real estate I've owned, yet I've never paid any tax on it. I've
Mhm.
only had tax benefits. And that's phenomenal. I can't say the same thing for stocks, cryptocurrencies, precious
Right.
metals. Nothing else does that but income
Mhm.
property.
Right. That's the way the law's written, so take advantage
Take
if you want.
advantage of it.
I do have one more question to unpack about mortgages. It's
Oh,
on my next slide there. It's a
all
long one.
right. Here we
We
go.
can look at that before we wrap it
You're
up.
not kidding. That's a long one. Okay.
From S. Armstrong. Is it possible for me to ask you a question? I tried to look back in the 70s about the mortgage rates. The housing prices were pretty steady rising, but the mortgage rates spiked twice. Freddie Mac took over all the intermediary exchanges of mortgages starting in 1970, taking profits from banks. The banks seemed to set the mortgage rates on the credit worthiness of the economy, meaning that the worse the economy, ability to pay back the loan, the higher the mortgage rate. Starting in the 1980s, the banks had to switch to the LIBOR as the mortgage rates. This took the profits out of the bank's hands because they could not raise rates depending on credit worthiness. Now the mortgage rates are moving to SOFR,
Yeah.
intraday
That's
bank
an index. Yeah, those are
index.
indexes
Uh,
that adjustable rate mortgages are tied
Secured
to. That's what
overnight
he's referring to.
financing. Yep.
Okay.
Do you think that the worse the economy gets, the Fed lowers the interbank lending rate, therefore lowering the mortgage rates? Or do you see the mortgage rates can go up? Thanks for any comments.
Yeah, that's the trillion-dollar question. I mean, if anybody knew that, they would be just incredibly wealthy because
Mhm.
they could play the market based on that,
Sure.
right? So
Uh-huh.
it's definitely a trillion-dollar question. Um, if you ask me, I think what the Fed is doing here is I think they're trying to just sort of spook the market with these rate increases to say, hey, look, we're halting inflation and we're serious about it. And they're going to do it. It's like
Mhm.
I was kind of trying to think of a metaphor for this today that's a good metaphor, but it's like if if you're running, well, you know what it's like? It's like something I do every morning. I did it this morning, and that is Tabata training, which is, intermittent training where you
Mhm.
do something really fast. I usually just run or jump on my rebounder,
Mhm.
and I do it for 20 seconds, really intense, and then I stop for 10 seconds and rest. And then I do it for 20 seconds again, really intense and high intensity interval training, right? And I
Mhm.
think that's what the Fed is doing here. They're trying to say, look, we are going to put a damper on this. The economy is just running way too hot and we're just going to cool it off. And overall they are going to cool it a bit, right? No question about
Mhm.
that because
Mhm.
I think they're right to do so. In fact,
Mhm.
I think they should have done it earlier and more gradually.
Mhm.
That was a mistake. And I think they probably agree with me that that's a mistake. But overall, I don't see rates going way, way, way up. I do see
Mhm.
them going up a little more, but I don't know. You've got to remember that we are in business with the government. And what I mean by that is the rate we pay, when we have to pay a higher rate, they have to pay a higher rate.
Mhm. Mhm.
And the government is so indebted that it's just obviously shocking, right? How much debt there is in the system.
Mhm.
And they want to debase their own debt through inflation. And they've had that opportunity. They have it now because their debt has gone down, because those dollars that they're repaying the debt in have become progressively more and more worthless. So good for them. But, you know, inflation, everybody complains about it, right? The best thing they could do is to start letting domestic energy production happen again, which Biden, ruined on his first day in office after being appointed. Notice I didn't say the E word.
Yeah.
Appointed. And be careful, we might not be on the air here much longer. So right here.
Yeah.
I can hold that up, and I bet the algorithm can't notice that. And if I move it around, they really can't. Yeah. So anyway, yeah, I think that's what's going to happen. But what do I know? Predicting interest rates is a fool's errand.
Right.
It's impossible to do. It really
Right.
is.
Right. You teach people to invest successfully in any market. That's what you're here to do.
Yeah, absolutely. So, and next one.
Next one. No, we have some more comments. I'd like these comments.
Let's grab those. And you know what? I'm going to find another visual for you that I just found this morning that I want people to see. And well, in fact, I know where to find it easily, but go ahead, Ashley.
Okay. Matthew Heyman at 636. Canada is a bubble. People can only lock in their mortgage for 5 years at a time at most. That sucks.
And Canada is a lot more expensive than the US.
Yeah. Mm-hmm.
Okay. The US is cheap compared to Canada, and people can keep these mortgages for 3 decades.
Mm-hmm.
Yeah.
Yeah, that's too bad. Eric Payne. Hi, Eric. Hey, Jason, I agree that the real estate market isn't adjusting anytime soon. With interest rates soaring, making it hard to cash flow on some properties, what do you suggest to keep your money invested and not depreciating in cash?
Well, what I suggest is that you buy income properties, and you got to wait for the rents to catch up, because the rents are lagging way behind the property prices, and they always do catch up, but it takes time for it to happen. And they are catching up. They will catch up, but it just takes time, and you've just got to wait it out. And these returns are dramatically better than you think. You've got to learn how to do the math. These properties, I was on Tom Wheelwright's podcast today. He's the author of one of the Rich Dad books called Tax-Free Wealth. I'm sure many of you have heard of him. And one of the things I was talking about is showing some examples of properties. For example, if people right now go to jasonhartman.com, click on the properties page, and browse properties in any of those markets that we have. And if you look at those properties and you look at those performers, I don't have one handy for me to easily pull up for you, but you can find a property that has maybe a 1%, I kid you not, 1% cash on cash return. And you'll think on the face, that's a terrible deal. But if you look at the overall return on that property, and I'm just pulling this out of the air, it may be 20, 23, 25%. When you learn how to do the math and learn how to analyze a multi-dimensional asset class like income property, you just see how most people don't know how to keep score. They can be making money when they think they're losing money because they simply don't know how to do the math. And the math doesn't lie. Okay, the math is the math. It's unassailable. That's better than inalienable. Well, it's inalienable too. But yeah, just you gotta learn how to do the math of that, and you'll be way better off. So I've got to do another kind of screen share here. I don't know if this will actually work, but let me try. We'll see if it works. Hey, it does work. Okay, so I posted this. This is our Empowered Investor Inner Circle. We changed the name to Empowered Investor Pro just recently, but I posted this today. And this is a quote from Andrew Jackson. And the reason this is fascinating is that he wrote a letter to Martin Van Buren in 1837. And this is the earliest example I can find that people were talking about my inflation-induced debt destruction strategy.
Mm.
And Andrew Jackson in this letter said, quote, "Those largely indebted want more paper." In other words, paper money, right? Fiat money.
Yeah.
The more it depreciates, the dollar being debased,
Mhm.
easier they can pay their debts. Andrew Jackson, May 15th, 1837. He understood
Mhm.
inflation-induced debt destruction way back then. Isn't that fascinating?
Really.
I mean, to someone like me who's a total nerd, that's fascinating, but maybe
Mhm.
maybe other people aren't that fascinated by it. I don't know.
No, it is fascinating. These are timeless, concepts, and we're still caught in the same trap. It's like we're not learning from the lessons of the past.
Yeah. That's what we do as humans.
Yeah. I know, I know. Keto Man, Jason, people do not know how to do math, not taught and dissed in place of feel-good classes and in public schools.
Yeah. And I like the name. I recommend keto. That's good. Although I don't do it very well, but I do it a little bit. Yeah, absolutely. That is true. It's a very sad state of affairs.
Well, that's great. Well, should we wrap it up?
Yeah. Did you want to talk about any of these other slides, or we'll talk about that next time?
Yeah,
Yeah,
next
we've
time. Yeah.
we've been on for a while. We promised this would be a short one. Okay, everybody. Hey, thank you so much for your comments. Thanks for joining us. We really appreciate it, and thanks to Ashley for co-hosting. I know it's been a while. Good to have you back on. And until next time, happy
Until
investing,
next
everybody.
time.
Bye bye.
Bye.